Hey everyone, happy Thursday, May 15th. It's a little after 11 a.m. on the West Coast, and it's time for another market update. Well, the big news over the weekend was of a trade deal with China. So the stock markets popped on Monday, crypto, jumped quite a bit. But like I try to explain to people, generally, if you hear like it's something that sounds like it's good for the country, it tends not to be good for mortgage rates. For instance, a trade deal, not good for mortgage rates. If we hear that unemployment, that the economy is booming, generally not good for mortgage rates. Whereas if you hear about something that sounds like it's awful for the country, that tends to be good for mortgage rates. Pandemic was great for mortgage rates. Unemployment going up, that would be good for mortgage rates. And a lot of that has to do with the system where, we want the Fed to cut their rates, and the Fed will not cut their rates if everything looks like it's going good. The Fed cuts their rates to stimulate the economy. So anything that makes it look like the economy doesn't need to be stimulated means less chance of the Fed cutting their rate, and that's ultimately what we want. So trade deal, good for the country, not good for mortgage rates in the short term, at least. April, the first piece of big data we got this week was April CPI inflation data. The Fed's favorite form to look at is the PCE data, but CPI is very important, and it came in the lowest since February 2021, which is good to see. So taking a little closer look, headline and core were just up 0.2% month over month. That brought the headline number year over year to 2.3%. The core number, which takes out food and energy, to 2.8%. And then if you looked at the 3 month run rating on the short term, it's even lower at 2.1%. So that's all good to see. But if we take a closer look, really what is keeping these numbers even higher than they should be is this shelter number. Shelter, really is running about 4% gain, inflation year over year. If you look at real time metrics, whether it's core logic or the different things that track rent and renewals and stuff, it's a lot lower than that. Some are showing negative, some are barely showing a barely positive. So a 4% gain is way out of whack. If we just kind of took that shelter number and plugged in what we think it is, based on real time data, our core CPI number would be closer to 2.3%, so a 0.5% drop. So good news to see inflation down, but I will say that a lot of the articles, and it's true, are looking at the CPI number and saying, hey, that's great, but that's before tariffs would take effect. So we'll have to look at the May number and the June number to see how things go from there. Next thing we got today was April's PPI numbers. That's producer inflation. So that's the cost to produce these goods that we consume. And the main story there is it came in negative, which is great. But the numbers are really unreliable, like I said on that slide. It's because they revised March so much. March came in negative month over month. They revised it to flat. A core number was negative. They revised it to positive. So even though the headline number for April came in negative, the year over year basically just got back to where it was. The estimate is 2.5. It looks like it dropped quite a bit, but that's because it was revised up from 2.7 to 3.4. So again, these producer numbers, producer price index numbers come from the BLS, which also gives us our job reports. And like we talked about, the data just doesn't seem to be reliable. So it's hard to put a lot of trust in these numbers when they do these big revisions. So even though it came in negative this month, how do we know they're not going to revise it to flat like they did March? So really interesting numbers to take a look at, but the market has reacted positively to negative numbers. Some of the PPI decline they're attributing to machinery and vehicle wholesaling in preparation for the tariffs. Walmart's admitting they're absorbing some of the tariff price increases for now. So I guess what they're saying is eventually that's going to hit the consumer. And then the PCE share components were all higher than March. So some of these numbers get put into PCE, they get put into GDP, things like that, and those were higher. So that doesn't necessarily bode well for that inflation number we get later this month. So good to see the goods or the numbers falling, but a little unreliable and have tariffs, completely kicked in yet. But good for inflation coming down. April retail sales. So April retail sales were up 0.1% month over month, just a little bit above expectations of flat. But the core number was down quite a bit at negative 0.2%. I believe that was supposed to go up about a third of a percent, so plus 0.3%. So, came in a 0.5% lower than expected. That does get plugged into our GDP. So that's actually a positive one for us. Like I said, if anything that makes it look like the economy is slowing down is good for mortgage rates. So that would be good if this core number is low and we're not spending as much money as a country. So that's a good one for us. That kind of played in our favor after some of the negative stuff the last couple of days. Next thing, so initial jobless claims. So this is all related to inflation and sales and stuff like that. But the other part of the Fed's dual mandate has to do with jobs. And the reason we look at initial unemployment claims is obviously people filing for unemployment will be one of our first indicators that the job market's slowing down. And that came at 229,000, right in line with estimates. Still really low numbers. Continuing claims came in a little bit higher, but again, job market, at least on the surface, it's continued to look strong. So where did that leave us? So average 30-year last week was 6.87. This week we're at 6.96 today, and actually yesterday it ended at 6.99. So that, like I said, I'm sure anybody with a 401k or paying attention to the stock market's had a good week. So a lot of that money gets taken out of mortgage bonds and U.S. Treasury yields and put in the stocks, and that tends to hurt us. So early on in the week, all bad stuff for us. Even with some good inflation numbers for us, still wasn't a good day. But today, with the PPI and the retail sales, there's been some pullback. Some pullback for us. So, like I said, came back from a 6.99 to 6.96. Still way too close to 7. We want to start getting closer to 6. But we've really been in this place for quite a bit now. So, it is the new norm. A lot of people, since they've started looking, we've kind of been in the 7 range. So we're getting further and further away from those really, really low rates. And to be honest, I'm not sure we'll get that low, when we'll get that low again. So, really a more realistic goal would be to get down into the lower 6s, maybe into the high 5s. And then that would probably kick off a pretty big, buying spree, pretty big boom in the industry with so much pent up demand. But right now we're closer to 7, not a good thing to see. So let's hope we get some good data going our way. Starting with, like I said, we got the PCE later this month, another jobs report, another CPI report like the one we got this week. And then the Fed is meeting again on June 18th. Right now, the markets have it at an 8% chance that they'll cut rates. 92% chance they will do nothing. So it still tends to be the Fed's waiting. They're waiting for more data before they make the decision. They don't want to make the wrong decision, so you can't blame them there. But for right now, we just got to be patient and know that we're going to kind of be in these high 6s, low 7s, maybe mid 6s if we're lucky, for the foreseeable future. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, I hope you have a great week, guys. Thanks a lot.